Hello, this is Anthony Parent of IRS Medic. Thank you for joining us today live. Today is Friday, April 12th. And if you are in the U.S. tax industry, you might not be watching this right now, as you might be a little bit busy. But we thought it would be a wonderful idea today to talk about top 3 things U.S. tax pros get wrong about Canadian taxes. And this is a big, big issue for the U.S. U.S. and Canada are kind of big trading partners. And with me today is a very special guest, an incredibly bright young man who is a fan of the channel. And this is Tyler Sheardown reached out to me. Tyler is a CPA who is located in Vancouver, British Columbia. And he reached out and we chatted a little bit. And we thought this would be a wonderful, wonderful topic to discuss because even myself, I could use a little refresher in some of these things. They get a little bit much. Tyler, my man, thank you so much for joining us today.
Thank you for having me, Anthony.
Right on. So we're going to get right into it. We're going to say, hey, what's going on here with the top 3 things people, U.S. tax pros are getting wrong about Canadian taxes. And so here's our first one. We're going to get to this one right here. This is the eligible versus non-eligible dividends. And I guess in IRS speak, we would be talking about qualified versus non-qualified dividends. But you guys up in Canada, things are slightly different, right? So where did we go wrong on this? And what I guess, what is an eligible dividend? What is not eligible?
Sure, Anthony. Eligible dividends are dividends paid from private corporations. It kind of has to do a lot with a concept called integration in Canada. But essentially, the private corporation will pay out a dividend, and then that dividend will be grossed up by 38% and put on the Canadian tax return. And then of that gross up, you get a dividend tax credit. So for example, if you had a $100 dividend from a Canadian controlled private corporation, CCPC, then if that on the Canadian T1, the individual tax return, it would show up as $138 as income. And then of that gross amount, that 38%, you actually get a tax credit of 6/11 of that, so 54% of that $38 on that income. But what I see most U.S. tax professionals get wrong is they don't realize that $138 is not $138 for U.S. tax purposes. It's only $100.
Okay. We probably don't have the time to get into why Canada does this gross up. I'm sure there's great reasons for it, but essentially what you're saying is like, hey, look, you're going to look at the return and you're going to see, and this is for when you have an eligible dividend.
Correct.
The eligible dividend gets the gross up. So when you're looking at a Canadian return, if you see dividends, you better ask your client, hey, is this an eligible dividend or not? Because if it's an eligible dividend, it's actually not the right number.
Yeah, exactly. You're going to have to back out the grossed up portion and then put that number, translate it into US dollars and put that number on the return.
Wow. Okay. So watch out for the gross up. And now with non-eligible dividends, it's just something that there's no gross up. They just come in as, what happens with those?
Nope. There's a different regime of gross ups and dividend tax credits. So with non-eligible, or as they're technically known, other than eligible.
Okay.
It's a 15% gross up. And then you, on that grossed up amount, you get a tax credit of 9/13.
So 90. Okay. So you get so on a non-eligible, it gets grossed up 15%. And then you get a tax credit worth 9/16. 9/13 of what?
Of the amount that was grossed up.
Okay. So okay. Got it.
Like if you were to get $100 of non-eligible dividend, it would show up on the Canadian T1, the Canadian individual tax return, as $115. And then at the very bottom, towards the tax credit side, I'm blanking the line, like line 40,000 something, you're going to get a dividend tax credit of 9/13 of $15.
Okay, and that tax credit is to offset your Canadian taxes, right? That's not your foreign U.S. tax. So actually, so what you're saying is like it doesn't matter what kind of dividends you're dealing with. It just sort of matters because you're going to have to look at no matter any dividend gets a gross up.
No, there's eligible, other than eligible, foreign and capital dividends, and the
Okay.
only two that get a gross up. So those are the four main ones. I think there's a couple others, very, very small ones, but
Okay.
those are the four main ones. Foreign doesn't get a gross up, and then capital dividend is a completely special thing in the Canadian tax system,
Okay.
which I do not believe there is a similar concept in U.S. tax law. It is
Wow.
almost always missed by
Okay.
U.S. professionals.
So anything to worry about with the capital dividends that might throw somebody off, or would it, you know, and I don't think we have time to go through all that, but is there anything to look out for there?
Yeah, so a capital dividend, I'll just briefly take 20 seconds to go through it.
Yeah, let's do it.
A T2 on a Canadian controlled private corporation at CCPC, when you get capital gains, say that corporation sold stock for $500,000, zero cost base. Of that capital gain, 50% goes into a bucket called capital dividend account. And then that dividend, that 250,000, right, over year it builds, and it's your net capital gains or losses. Eventually, when you want to pay it out, you can file a special form with the CRA, and you can pay it out completely tax-free to the shareholders. All was fine, all was fair in love and war, except the US does not recognize that tax-free status of a capital dividend. So when a capital dividend from a CCPC gets paid out, it's not going to show up on the Canadian individual tax return, but it would need to show up on the US individual tax return, right? It's taxable income for US tax purposes. So then you're out of luck if you didn't plan correctly and you receive a capital dividend. You have to report that. But of course, there would be no offsetting foreign tax credit or any way to kind of
right. Yeah. So, oh my. All right. So I think we covered dividends here, and I want to move on. We want to move on to get to some other things. So, I mean, this is I think the humbling moment I'm having right now is that, you know, I often think, you know, the U.S. tax code is the most complicated thing on the history of the planet. And it may be, but, you know, Canada is there. And they're trying their hardest, aren't they? They're really, you know, they're punching above their weight class, I would say, as the term is. They're really getting out there and inspired by our own Internal Revenue Service. So wow. Much more. I thought this was going to be a little bit easier to understand. Okay. All right. So we're dealing with the IRS of Canada. So therefore it's not so much. All right. So let's move on. So we got to look out for those eligible versus non-eligible dividends. And look out for those gross ups. And the capital dividend is you're going to get probably too late to do anything about that on a planning aspect. Once you have it there, it just goes into a different place. All right, let's move on. Maybe this has got to be a simpler topic. Principal residence. This has got to be easy, right? Please help me out here. Please help me to make this easier than what the qualified versus or eligible versus non-eligible dividends.
For the most part, it's
thank you.
Generally simpler, but there's a lot of things to consider. So in Canada, if you live in a residence and you don't trip over the property flipping rules, which basically say you can't sell it within a year, or else you can sell it within a year, but you're not going to get the exemption claim.
Okay.
But if you sell your principal residence, it's an unlimited amount, like unlimited gain is deferred or not taxed. Excuse me, it's tax-free. So you sell it for $3 million more than you bought it, and you don't trip over any of the new rules that's coming out, the property flipping and all of that, then that gain is completely shielded. However, a U.S. citizen or U.S. person living in Canada now has to worry about two additional things with the principal residence. First, as you know, with the 121 exemption in the US, it's only up to 250,000 US dollars. But in Canada, the gain is completely shielded. So you could imagine a situation, and this is extremely common in Canada, whereby a person has bought a home, and then the Canadian housing market skyrocketed. Now they want to sell the home, but they don't have any taxes for Canadian purposes. But now they have taxes for US purposes because it's way above the 121 exclusion. And this is extremely common in situations where a US person marries a non-resident alien, in which case the exemption cannot be combined with your spouse.
Oh, right. When you have okay, right. That would make sense. Your spouse is a Canadian, not a dual, and that makes a lot of sense. Wow. Well, and I'm just sort of going through my mind, because now I'm maybe understanding, the Canadian real estate market a little bit better, because where you are in Vancouver, I mean, it's been hot for years, and now it makes a little bit more sense to me. Why? Because Canadian taxes are not a lot of fun. This is huge and completely different than in the US. And, I could even imagine, this is a situation that, just inheriting a Canadian, if you ended up with a Canadian property worth, $10 million, and that's your only thing. And I'm not going to be taxed in Canada. The taxes in the US would probably approach 23.8% with all your plus on top of it, right? So you're looking at, a $2.3 million tax bill to the US, to the country that you, right? And so right there is like, well, that might be a situation where, you got to, maybe think about renouncing. Like, do you really want to, I mean, that's incredible. You may really want to renounce, if that's something that's huge in your portfolio, because you otherwise you'd take it tax free. But wow, there's the IRS saying, hey, give me. Wow. Okay. So that's a huge thing, that you won't have a tax credit on the sale of your principal residence to apply to the US. It's just straight taxation to the US, just straight right in there. Anything else that is important? I mean, I know we don't have time to get into every detail. We're just trying to hit the broad strokes of the main things. Anything else on the principal residence? And why does it say other real? Why does it say other real estate? I guess.
I think I'm not quite sure just looking at this, but I think there's like exemptions for certain cottages. Like if you go between a few houses, I'm not quite sure. Just looking at this.
Yeah, and well, I'm also seeing that this is a different rule here too. It says this: if the property was solely your principal residence for every year you owned it, you do not need to pay tax on the gain. Now, that is different than the home than Section 121 of the home sale exclusion, because there you don't need to live there every year that you owned it, and it could only be of, I think, 2 of the last, 2 or 3 of the last 5 years. I mean, that's all it requires. So that seems like it can, hang up a few people, but for some people, we really won't. But the rule is a little bit more. There's no there's no cap on it, but it seems like it's a tighter qualification.
Yeah, exactly. You do get the +1 rule in Canada.
What's that?
It basically just says that you, for the years that you say that you lived in it, you can add 1. So maybe you own the place for 10 years. And you were physically living in it for 5. On the T2091, the principal residence claim, you get to say 6 of those years where I was living in it, and in that case, you'd be able to exclude 60% of the gain.
Oh, so they actually prorate it. Oh, wow. Yeah, the IRS, it's all or nothing, right? It's an all or nothing. But wow, okay, wow, that is that's very different. All right, that's great.
Yeah. And a couple things there also is, for U.S. tax purposes, if you have a mortgage on that property, and the rates of the mortgage fluctuate favorably in terms of the U.S. dollar, like on the date that you got the mortgage, and then the date that you are released from the mortgage, you pay it back. If there's a favorable gain on the U.S. dollar, that is that as measured by US dollar, your total liability went down, you're going to have to pay a foreign mortgage. You're going to have to pay taxes on that gain. So nothing happened, just exchange rates. But
Yeah.
since you're a US person, everything has to be measured in US dollars.
The US dollar. Oh, wow. Right. Oh, man. So that's a really, wow. So if you are a US person with a residence in Canada, watch out. Watch out. And it's not Canada that's going to hit you. It's going to be the IRS.
Yes. Well, Canada has been getting really, really aggressive with the principal residence, mainly because Canada's real estate market's out of control.
Yeah.
Can afford it. And then the other thing is, as you said, is that a lot of people's whole wealth is shielded in their principal residence.
Right. And that's the thing. So you have people buying more house than they need because the expectation is, well, this is my nest egg that will be non-taxable. And so it's actually, I would say this entire tax treatment is what's driving up. It's probably one of the larger forces driving the prices up and the market up, because of what would happen if this, tax treatment went away. Would everybody want to have, oh, wait, I don't want to have that much house. But right, you have every incentive to keep as much as your portfolio in your primary residence. And I mean, unless you're a U.S. person, then you really don't have that same incentive. Wow. All right. Anything else to add before we move on to our final topic?
I think we hit the major ones there.
Yeah. All right.
There's always more nuances, but I think we got the major ones.
All right, great. Let's go to the last one. Tax-free savings account. Hey, look, saving just got a whole lot easier. I think in America we would say savings. Savings just got a whole lot easier. So I think that might be some of the Canadian translation there. So what's a little bit about the tax-free savings account? Tell me a little bit about that.
Sure. The TFSA, if I remember correctly, was introduced in 2009.
Yes.
Basically, it allows you to contribute, I'm thinking $6,000 a year, Canadian dollars.
Okay.
To this account. And it's kind of unique in that you can withdraw or you can input money. You can withdraw or take money out a lot more liberally than US retirement plans. So if you wanted to take the money out, you can do that without as many consequences. But basically, it's most similar, asterisk on the word most, to a Roth IRA, in that you don't get a deduction for putting money into the TFSA, but any money within the TFSA can accrue tax-free for Canadian purposes. So
then what happens on that American end there, Tyler? Oh, let's move on to the next banner. What happens on the American end? So hey, Canada says it's tax-free. So what does the United States, what does the IRS say?
Well, this one's ugly. And this one is where you can get into some trouble, and there's not actually a clear answer.
Imagine that. Imagine that. Wow. Okay. So, how ugly are we talking about here?
Well, it's generally agreed that any income within the TFSA is taxable for U.S. purposes. So not only is it not taxable for Canadian purposes, now it's taxable for U.S. purposes. Well, that's usually you can take foreign tax credit from other income, so you might not have to pay tax on that, depending on if you have other sources of passive income. You do have to include it on your 1040. But that's not the really ugly part. The really ugly part is, how do you treat the TFSA? Is it considered a foreign trust for U.S. purposes? And a lot of practitioners have gone the route of doing a 3520, 3520A type of disclosures for it.
Right.
So basically, you have to consider it's like a foreign non-grantor trust, in which case, anytime you contribute, you got to do the 3520. Anytime you take distributions, every year you got to file the 3520A and 3520. And it's a big, big compliance headache for most clients I've seen. Almost no tax savings. It costs more in compliance.
Right. Yeah.
That's
right. That's worth. Right.
Now there is a huge debate in the Canadian tax community about whether, or the U.S. tax community in Canada, about whether the 3520A is needed, in that can you do an 8275 disclosure statement? Is the TFSA considered a foreign trust? And the debate kind of goes along the lines of, for something to be a trust, you have to be able to sue it, and you can't really sue your own TFSA account, right? And according to U.S. law, U.S. definitions of trust, can the TFSA really be considered a trust? And that causes huge headaches. Now, the funny thing with the IRS is there's been numerous requests, private letter rulings, requests for the IRS to just tell us what to do so that we may be compliant and live happily ever after, right? Because that's the point of tax authority, is to help us out so we can, do our duty as U.S. persons, right? But they just won't answer it. They will not give you guidance on what the TFSA treatment is. And so a lot of people, under being the guise of being safe, will do the 3520, 3528. Other people will be a little bit more risky, or not risky, but more, what's the word? Direct. Just disclose it on the 8275. Don't do the 3520 combo and move on. But it's unclear. They have not issued guidance.
Well, this is the, constant topic of ours, and I'm going to have to add this to the list. I didn't quite do that. We typically don't do a 3528, 3520. It just seems wildly inappropriate that, I don't see it myself. I don't see that it's a foreign grant or a trust myself. And this is a common situation that we encounter where the IRS is intentionally opaque. It's very, this is we talked about passive foreign investment companies. We've talked about they're intentionally opaque. The IRS is completely aware that the tax industry is convinced that foreign mutual funds are all passive foreign investment companies. And there's actually nothing in writing from the IRS that is true. And if you actually look at the history of law, and John Richardson and I covered this at length, that the entire wisdom behind that passive foreign mutual, that the PFIC law was intended to punish foreign mutual funds is just bunk. It doesn't add up. The story doesn't add up. But there's that's an issue where the IRS won't tell people what they actually want. Then we also see it in Australian superannuations. The IRS won't give. Again, it's is this a foreign trust or not? And it's a question we have. And now where we're at is we're giving clients the options, because if you actually look at the law, Australian superannuations are classified as Social Security in Australia. What the U.S. tax industry does is it applies, well, it's not like U.S. Social Security, as if U.S. Social Security is the only Social Security that can exist in the world. And so in the IRS, in that case, won't give any guidance. And here we go. Tax-free savings account. Boy, and this impacts basically every U.S. Canadian person, right? Pretty much everyone has one. I mean, this seems like something kind of ubiquitous.
Yeah, a great deal of people have it. I wouldn't say pretty much everyone, but it's fairly common in Canada.
Fairly common, probably like 80% of people, something like that.
Probably, I don't know exactly. I'd probably say like 60%.
60%, right? And I don't. Do you know how many dual U.S. Canadian citizens there are? I don't know off the top of my head. Do you have any idea?
It's not entirely clear. There's estimates as high as 1 million people who have U.S. 1040 obligations in Canada.
Okay.
Living in Canada, but I think the number I've seen is around 700,000.
Okay, and that seems about right to me. That 700,000 would seem about right to me. So you're having an issue that impacts 700,000 U.S. tax filers, and there's the IRS saying, "Well, we didn't hear anything. What? What? They don't know. They don't know how to respond, I guess." Now, and this is what I would say about it, Tyler. So why is the IRS this way? And what's been happening recently is the IRS has been losing cases. They've been losing cases. They lost the Christensen case, where they were trying to determine what French law was, and also the Eshel case, the same thing. They're trying to determine what French law was, and they got slapped down. They say, no, IRS, you don't get to determine what French law is. French law determines French law. And I think that sort of explains a lot of this opaqueness. The IRS wants to create this massive filing regime, but they don't want to be challenged on it. And when they actually stay where they stand, now you could say, oh, actually, you're wrong. But when they are nothing, how do you fight them, right? How do you, and I didn't even realize people actually requested a private letter ruling is your request. You write a check to the IRS and say, hey, look, can you tell me the result of this issue? I did not realize there were private letter ruling requests that, I mean, what have you seen? Have they come back as what? Like they just don't answer it?
Yeah, it's just not, they don't rule on it. They just will not rule on it.
I hope they give people their money back who asked for it. That is insane because that was actually going to be one. And I got to see if there's any rulings on these other things. So wow, the IRS is intentionally opaque, and that's what we're dealing with. And so how do you feel about, jumping? You're a bright young man. How do you feel about jumping into this world? Did you know that you were going to jump into a world of somewhat crazy absurdities? How did you feel when you kind of like what when you saw what was going on?
I mean, I thought it would be interesting and unique because I thought the more complex the better. But now I'm realizing I'm aging faster than I should.
Yeah, right, exactly. Yeah, you really you're really going into it. It was a slower reveal to me over many years. Is I took bite size, and I think you jumped into ground zero of just some true tax insanity of where it's so complicated the taxing authority can't control it. And that's where and that's what we've discussed is that what's happening is because you have these complicated things. Who ends up writing the law? And the answer is the tax industry. The tax industry ends up writing these laws, and there becomes conventional wisdom, and then the taxing authorities will accept that conventional wisdom as the law. So kind of a crazy thing. Anything you're thinking of doing to combat all this craziness? Anything that you're thinking of doing?
Well, I'll be heading to law school in the spring, and then I'll be joining. My goal is to become an international tax lawyer like you, Anthony.
Oh my God!
I can deal with this at an even higher level. Although I've seen quite a bit of insanity, and I understand how the IRS can be very punitive for no reason at all. But sure, they're inspiring the trust of the American person.
Oh my God!
They're fulfilling their mission of being integrity and honesty or whatever they say on their mission.
Yeah, whatever they're saying. Well, I'm that's awesome. So, do you know where you're going to go to law school?
My goal is to go to Texas A&M.
Oh, all right.
They have a lot of international tax.
Yeah, there's a professor there, Jack Manhire. He is a great guy. He went to and I got introduced to him because he wrote an article on what it meant, what voluntary compliance meant for IRS. And it's sort of funny. The word term, I'll just tell you what his article was. His article was that voluntary compliance is an inside IRS term. It's not meant to be used by people on the outside. Voluntary compliance is did you need to audit that client? No, they voluntarily complied. That's what it meant. It's not that this is a system of voluntary compliance. Not at all. No, it's mandatory. And will you volunteer to do your job in this mandatory system, or will they have to enforce it? That's actually what it means. So he's an interesting guy. He was at Yale. So yeah, they had seemed to have a strong program down there. That's awesome. What about the LSAT? Are you taking that?
I'm taking that today.
Oh, well, oh my, wow. All right. You did your prep?
Very much.
All right. That's
prep, but
all right.
I'm very confident I'll do well.
I think you're going to do well. I mean, you seem to, I just have a feeling that you're going to be a star in the tax world, my friend. I think you're going to be there. So I really, I want to have you as a recurring guest, especially during law school. And as we go along, because I know you're going to uncover a lot of interesting things. And I think our audience would really like that. And I mean, this is really amazing. The upstart I have. Oh man, you're really going to be something, Tyler. You're going to be the man soon.
I have hundreds of topics to talk about.
All right, cool.
With all of the nuances.
All right. Well, I want to just thank you so much for taking the time out today. I mean, you have a big day ahead.
Yeah, I'm excited. Well,
Yeah.
as much as you can be.
All right. Awesome. All right. Well, thanks for joining us. And I want to just thank everyone for joining us today, and you know what, and be sure to give a thumbs up for Tyler. He's doing a great job. So this is Anthony Parent for IRS Medic. And by the way, if you haven't subscribed and turned on those notifications, I really suggest you do, because we do go live a lot of times and we'll take your questions. So do that, and that way you won't miss anything. This is Anthony Parent for Tyler Sheardown. Thanks so much for watching.
Thanks, Anthony. Have a good one.